Let's start with very interesting topic, and that is CARO 2020. There is section 143 subsection 11, which says that it gives power to central government that you can consult with NFRA, National Financial Reporting Authority. You can talk to them, consult with them, and you can issue order on the auditors. And this order will be for additional reporting. Auditors can be asked to put additional matters in their audit report. And using this power, government has issued CARO 2020, Company Auditors Report Order. All the company auditors are supposed to follow this order, which talks about additional reporting while preparing audit report. Now, as the name suggests, CARO 2020 was introduced in 2020, and it was applicable from financial year 2021. So it was deferred, not 2021, 1920 in fact. First time CARO 2020 came, they made it applicable from 1920. Then they changed from there and they say that it is now 2021. They further deferred it because of Corona, COVID, other issues. And finally, it got applicable from financial year 21-22. So CARO got applicable from financial year 21-22. So we have CARO based reports available now as per CARO 2020. If you see CARO, the structure is very simple. Very simple. CARO is having 4 paragraphs. Paragraph number 1 talks about applicability of CARO. To which company auditors CARO will be applicable. It talks about applicability, that is important. Paragraph number 2 says that comments which you are going to make as per CARO order, they are integral part of audit report. So wherever audit report is circulated, those comments should also be circulated. That's fine. That's a one-time thing, not very important. Then paragraph number 3 contains 21 clauses. 21 clauses on which auditor is supposed to report. And paragraph number 4 says that whenever you make any adverse comment, negative comment in CARO, always give reasons. If you are saying something is wrong, something is incorrect, then always give reasons. Giving reason is extremely important. So here we are. That first we talk about applicability. That is the most important paragraph, and then the matters. So you can just remember that paragraph number 1 is for applicability and paragraph number 3 gives all the clauses, because we may generally these 2 paragraphs are referred again and again. So we can write it when giving our answers. Let's see. So applicability. CARO order is applicable to all the auditors of all the companies, including foreign company. Yes, including foreign companies. So first they make it applicable to auditors of all the companies, including foreign companies. So if audit report is prepared for foreign company, then it will include CARO reporting also. That's interesting. That's very interesting that you are making audit report of foreign company. While making audit report, you have to include matters as per CARO 2020. Then they start giving exemption, and they're giving 6 exemptions. Shortcut is IB Corps. I for they have given exemptions to auditors of insurance companies, auditors of banking companies, auditors of C for charity purpose company, that is section 8 company, then auditors of 1 person company, IB Corps. Then P stand for private company which is small from all the angles, okay. So even private company will get the exemption, but provided all the 4 conditions are satisfied. Small company, all the companies which are covered in definition of small company will also get exemption. Small company also includes private companies. So private companies have 2 options: either to get exemption in private company clause or get exemption in small company clause, either of them. Let's see, guys. So we know about insurance company, banking, charity purpose, one person company. Now these are extremely important. We are going to see cases later. Just see the conditions first. So, private company will get exemption from CARO provided they are small from all the angles. So, first angle, they should not have a public company sitting as a holding or sitting as a subsidiary. Public company should not sit as a holding company or as a subsidiary company. So they should stay away from the public company. Number one. Second, their share capital and reserves. Share capital and reserve should not exceed 1 crore as on balance sheet date. Okay, so be careful. Recently, there was a question in which they gave opening balance of the reserves and they gave loss for the year. So loss for the year will get adjusted, balance will reduce, and you have to take closing balance to check applicability of CARO. Then next you see paid up capital and reserves. It should not exceed 1 crore as on balance sheet date. Loans from banks and financial institutions should not exceed 1 crore. Again, 1 crore limit at any point during the year, but the wordings have changed. When it comes to paid up capital and reserves, the wordings are as on balance sheet date. When it comes to borrowing, the wordings are any point during the year. Then total revenue should not exceed 10 crores during the financial year. So there are 4 conditions. So in holding and subsidiary, we don't want public company. Paid up capital reserve should not exceed 1 crore. Loans and borrowings from banks and financial institutions should not exceed 1 crore. And total revenue during the year should not exceed 10 crores. Okay. As I said, we'll see cases later. Now, definition of small company. Definition of small company. Let's compare. When it comes to small company, if any company is a small company, then auditors will get exemption from the CARO reporting. Okay. Let's see definition of small company. It is, first of all, they say other than public company. So the earlier exemption was for private company and other than public company. That means again they're talking about the private company. So both exemption number 5 and exemption number 6, they're about private company. Now let's compare them. It improves retention. So earlier the condition was there should not be public company in holding and subsidiary. In small company, they say that there should not be any holding, any subsidiary. If you are having holding or subsidiary, then how come you are small? No holding, no subsidiary. You should not be a Section 8 company. If you are a Section 8 company, you cannot take benefit of small company. No holding subsidiary, no Section 8, and finally, you should not be governed by special act. Like LIC, SBI is governed by special act. You should not be someone governed by special act. So this is neck to neck comparison of the first condition. Then they say that the paid up capital and reserve should not exceed 1 crore. Here they say that here they talk just about paid up capital. Limits are revised recently. Only paid up share capital. It should not exceed 2 crores. So these are higher limits. In small company, limits are comparatively higher. So more companies will get covered in the definition of small company and more company will get exemption from CARO. Higher is the limit, more companies will get covered here. So paid up share capital should not exceed 2 crore. If government wants, they can increase this up to 10 crores. They can increase it, but as on today, it is 2 crores only. Then, next condition was with respect to borrowing, loan and borrowing. There is no limit of loan and borrowing in case of small company. No limit of loan and borrowing. That means, irrespective of how much loan and borrowing you have from banks and financial institution, you are always eligible to be a small company. That's not going to have impact on small company. You are always eligible. Then the last was, they said total revenue should not exceed 10 crores. Here they say turnover. There's a difference between the word total revenue and turnover. We'll discuss about this later, but the word has changed. They said total revenue should not exceed 10 crores. Here they said turnover of last year P&L should not exceed 20 crores. There's a difference at 3 points. First of all, the word is different. They talk about total revenue, we talk about, here they talk about turnover. That is the difference. There they talk about current year turnover. Here they talk about previous year turnover. So keep in mind, if they're talking about previous year turnover, that means we have to check small company definition. There the amount is 10 crores. Here the amount it should not exceed 20 crores. And this amount can be further increased to 100 crores. It can be further increased to 100 crores if government wants, but they have not increased it as on today. So these are exemptions. These are 6 exemptions, and we have compared exemption of private company and small company. Now, now let's see cases on them. As I said, it's very simple, straightforward, and if you see these cases, it literally covers everything. We did a lot of research on the guidance on CARO, and after analyzing that, we have framed these cases quickly. So first thing is CARO applicable to audit report of consolidated financial statement. CARO is framed from a point of view of a company, not from the point of view of group. So CARO is not applicable to audit report of consolidated financial statement. It's not applicable. But out of 21, there is one clause which will be written in audit report of consolidated financial statement, and rest 20 clauses will be written in audit report of standalone company. There is one clause. In general, CARO is not applicable. In general, CARO is not applicable to audit report of consolidated financial statements. Okay. But then, so let's discuss one more thing. Now, it's not applicable to consolidated financial statement audit report. Is it applicable to audit report of a company? Of course, yes. It is applicable to audit report of a company of standalone financial statement. It is prepared keeping a company in mind. Will it be applicable to branch audit report? Answer is yes again. Branch auditors will finalize their report and send it to the company auditor. Then only we can have audit report of the company. If branch auditors are not doing it, how will company auditor prepare his own report? So when it comes to group level, answer is no. Is it applicable to company level audit report? Answer is yes. Branch level audit report? Answer is yes, it's applicable. And interesting that 20 clauses are for reporting in case of standalone financial statements, and one clause number 21, clause number 21 is for reporting in audit report of consolidated financial statements. Now let's see. The first question is, this order is on the company or on the auditors? Obviously, it is on the auditors. Auditors have to read it, understand it, and implement it when they are preparing their audit report. Is it applicable to audit report of consolidated financial statement? General answer is no. Answer is no. Only one clause number 21 is applicable to audit report of consolidated financial statements. Is it applicable to branch audit report? Whether they are going to get exemptions? No. Okay, they are not going to get exemptions. It will be applicable. Now, in the same sequence, I is for insurance. I is for insurance. Whether life insurance companies and general insurance company both will get exemption? Answer is yes. Auditors of both the companies will get exemption. What about banks? All types of banks will get exemption. Cooperative bank is not a company as per Companies Act. So CARO is not applicable altogether. It's not applicable. When we talk about foreign bank is a bank as per Banking Regulation Act. Foreign bank is a bank as per Banking Regulation Act. As per Banking Regulation Act. So, as per Banking Regulation Act, guys. So again, CARO will not be applicable to audit report of a foreign bank. When we talk about NBFC, it is not a bank. It is non-banking financial company. Non-banking financial company, so as it is not a bank, they will not get the exemption. So NBFC converted to the bank. If NBFC is converted to the bank, okay, then we have to see status whether entity is a bank as on balance sheet date. If it is converted to the bank as on 31st of March, it is a bank, and because it is a bank, report will be made for a bank. And if report is made for a bank, CARO, you will get the exemption. CARO exemption, you will get the exemption. No need to apply CARO. We are discussing whether they will get exemption or not. In next case, bank is converted into NBFC as on 31st of March. Entity as on 31st of March. As on 31st of March. As on 31st of March, it's a NBFC. NBFCs don't get exemption, so they will not get exemption. Okay. These things are again repeated in the form of case studies. Cooperative bank, don't worry, CARO not applicable. Foreign bank is covered in definition of a bank, so they will get the exemption. NBFC will not get exemption. 31st March, it's a bank, they will get exemption. 31st March, it's a NBFC, will not get exemption. Section 8. Section 8 is nothing but charity purpose. Section 8 is nothing but charity purpose entity. If we are talking about charity purpose entities, okay, charity purpose entities, they will get exemption whether they are registered in the old act or new act, doesn't matter. And we have to check the status. If they are silent, we have to check status as on balance sheet date. Now there are 4 conditions of private company. We'll discuss, we'll see these along with the cases, and then we'll come back and have an overview quickly. Let's see these cases. These cases will cover all the critical points. The first thing is whether all the 4 conditions are required. Answer is yes. If a private company wants to claim exemption, all the 4 conditions should be satisfied simultaneously, cumulatively. Just satisfying 1 or 2 condition is not going to give you exemption. Now, very simple case, that a private company was having a holding company, and that holding company was a public company. So basically a public company was acting like a holding company. We have a public holding company for a private company. 75% holding. Now this was the status till 15th of Jan. And but then after that 30% shares were sold. So holding came down to 45%. Moment holding came down to 45%. Now they are not having public company. They are not having public company as a holding company. Okay. The question is, when we have to see the status? Whether we have to see the status during the year, or we have to see the status as on balance sheet date. And as we have discussed earlier, if CARO is silent, we have to see the status as on balance sheet date. Okay. So here, as on balance sheet date, holding is just 45%. Private company is not having public company as a holding. So condition is not breached. They will get exemption. That's very interesting. How shareholding keeps changing, and you have to see the status only as on balance sheet date. Now, next thing is whether private unlimited company will get the exemption. Okay. Now, if you go back and you see the exemption list, they have used the word private limited company. Okay. So looking at it, you will feel that only private companies with limited liability, only they will get exemption. But guys, if you go to the guidance note on CARO, they have clearly and categorically, specifically they have said that private limited company, as given in the order, it means private company. As per Companies Act. And private companies, as per Companies Act, includes both limited as well as unlimited companies. It includes both. Okay. So be careful, guys. Students may make mistake. Even professors make mistake at this point, at this particular point. So both will get exemption. Both will get exemption, whether it is private limited company or private unlimited company, and it is clearly given without any doubt in guidance note. Okay, so limited as well as unlimited, both will get the exemption. Now next is, there's a so both will get the exemption provided again all the conditions are satisfied. Now in this example, capital is just 90 lakhs, it is not exceeding 1 crore. Loan is 85 lakhs, it is not exceeding 1 crore. Turnover is 7 crores, it's not exceeding 10 crores. So basically all the conditions satisfied. Will they get the exemption? Yes. And this is very important because in CARO 2003, the situation was different. They were not giving exemption to unlimited companies, but now exemption is available to unlimited companies also. Now, a very interesting case. Now, this case is extremely important. And why it is so important? Important and interesting. Okay, let's see. What is this case? So I've drawn a diagram for this. First, just understand the example, and then you can also draw. So we have a private limited. We have a private limited. Okay. A private limited, and it is having a holding company, and that holding company is a public company. So in holding we have a public company. If in holding you are having a public company, then condition is broken. Condition is broken, no exemption will be available. And this public company is based in India, incorporated in India. So we are saying it's a domestic public company. Now let's see the next situation. B private limited. B private limited, it is also having a holding company. It is also having a holding company, but this holding company is not registered in India. It is registered outside India. That means it is a foreign company. It's a foreign company. And as per foreign law, it is a public company. What will happen? Let's understand. See, foreign company means a body corporate. It is registered outside India. It is not registered in India. If any company is registered in India, it is a company. If it is registered outside India, it's a foreign company, it's a body corporate. And if you see definition of holding and subsidiary, they use the word body corporate. That means foreign company, which is a body corporate, can get status of holding and subsidiary as per Indian law. Correct. But if you see definition of public and private, it is not having the word body corporate. That means this foreign company cannot get status of public or private as per Indian law. As per Indian law. And we are bothered about Indian law. We are not bothered about what foreign law says. So as per Indian law, it is a holding. It is a holding, but we cannot call it public or private. If we cannot call it public, then no breach of condition. No breach of condition, and exemption will continue. It's very interesting, isn't it? So if you are having a holding, and in that there is a public company, if you are having a holding in which a domestic public company is sitting, then there will be breach of condition. But if you are having a holding in which foreign public company is sitting, it will not be a breach of condition. In fact, it is designed in that manner because Ministry of Corporate Affairs and Indian government wants to encourage foreign companies to open companies in India and come and do business in India, come and do economic activity in India. So this is designed in such a manner that foreign companies are encouraged, come to India, open private companies, do economic activity, generate employment, etc., do everything. And don't worry, your foreign status is not going to affect status of private companies in India. Okay. So that's what is explained in this example, that what if foreign companies get involved? What if foreign companies sitting in holding? What if foreign companies sitting in subsidiary? The conclusion is they don't get the status of public and private. They don't get status of public and private. So they cannot breach the condition. Okay. That's the conclusion. And this exam, you can draw this complete thing. You can draw this complete thing. This will explain everything. This explains everything. Now, next is very interesting. How will you compute paid up capital and reserves? Paid up capital and reserves. So let's see. First is, will you consider equity share capital? Of course. We will consider equity share capital. Of course. We will. So equity will come. It will be added. Then whether we'll consider preference share capital? Yes. Preference share capital is a part of paid up share capital. Then whether we'll take general reserves? Of course. It is said paid up capital and reserves. So general reserves will come. P&L debit balance. As per revised schedule 3, P&L debit balance is adjusted in the reserves and surplus. The complete reserves and surplus may go negative. In fact, complete shareholders fund may go negative, but it has to be shown in reserves and surplus. It is never taken to the asset side. That was the old approach. So yes, complete P&L balance should be adjusted. Complete whole P&L balance should be adjusted. Securities premium, it's a restricted reserve. See, CARO uses the word reserves. Word reserves. And reserves will include both. Reserves will include both, whether it is restricted or whether it is unrestricted. Reserves will include all the reserve, restricted, unrestricted, realized, unrealized, it doesn't matter. Capital reserve, yes, even that will come. Share application, it won't come. Why? It is not a capital yet, and it is not a reserve. Neither it is a capital nor it is a reserve. It won't come. Share forfeiture. Share forfeiture is a account with a credit balance. Share forfeiture is a account with a credit balance. Okay, and this account is added to paid up share capital. Paid up share capital. There is only one thing which is added to paid up share capital, that is share forfeiture, and one thing which is deducted, that is calls in arrears. Will you add share forfeiture? Yes, it is added to paid up share capital. Revaluation reserve. Revaluation reserve is part of reserves and surplus. Reserves and surplus doesn't matter if it is realized or not. Capital redemption reserve. Capital redemption reserve, it will be added to reserves and surplus. Share option outstanding account. Share option outstanding account. Share option outstanding account. When you do accounting for ESOP, that is the time this account comes up, and it is part of reserves and surplus. We will consider it. If you add all of them, it is only 87 lakhs. If it is 87 lakhs, guys, then it is not crossing the limit of 1 crore. Exemption will continue provided other conditions are satisfied. So see, this can come as a 5-mark question. We are getting prepared for the bigger case studies with the help of these small case studies. So we have seen a case on the first condition, that in holding and subsidiary there should not be a public company. We have seen case on that. Then next, paid up capital and reserve should not exceed 1 crore rupees as on balance sheet date. Next is about borrowing. So loan is 40 lakh rupees and interest 8 lakh is interest due. 8 lakh is interest due, and unpaid is 12 lakhs. So we have 40 lakhs as a liability loan, and then we have 8 lakhs as interest due and 12 lakhs as interest accrued. Interest accrued is 8 lakhs and interest due is 12 lakhs. So in liability side, we are having three things: 40 lakhs as a loan, 8 lakh as accrued, and 12 lakh as due. How much we'll consider in borrowing? Guidance note says that, see, 40 lakhs is a borrowing for sure. And then interest due, that is 12 lakhs, that should be taken. Why? Because bank will start charging interest on the outstanding interest. Interest on the outstanding interest. Okay. So borrowing should be 40 lakhs plus 12 lakhs, 52 lakhs. Interest accrued is 8 lakhs. It is not yet payable. It is not yet payable Nobody is going to charge interest on that. So guidance note says that leave it. Okay. It's very simple, straightforward. Loan should be taken, interest due should be taken, and the temporary interest accrued should be left out while computing borrowing amount. Now, next is fund-based facilities. If you go to bank and you take money in either of the names, whether it's term loan, or whether it is CC, OD, or anything, that's funded facility. But if you go to bank and you take guarantee, letter of credit, comfort letter, then that is non-funded facilities. We will count only funded facilities. We will count only funded facilities. We will never count amount of guarantee we have taken, amount of comfort letter we have taken, amount of LC we have taken. But if these non-funded facilities, okay, they get devolved on the company, that means now amount is payable to bank under guarantee, amount is payable to bank under letter of credit, amount is payable to bank, okay, if it is if under comfort letter, if amount gets payable, if the liability has devolved, come on the company under these facilities, then even they will be counted. Okay, so as such, it's very simple. Only funded facilities will be counted, and the day non-funded facilities get devolved, they come on the company, even they will be counted. Next is out of loan of 30 lakhs, 5 lakhs is due within 12 months. 5 lakhs is due within 12 months. What will happen? See, if you see the schedule 3 and the revised schedule 3, it says that there's a loan of 30 lakhs and 5 lakhs is payable within 12 months. Okay. It says that split it. In balance sheet, show 25 lakhs as a long-term borrowing and show 5 lakhs as a short-term borrowing. Earlier, before schedule 3 revision, it was shown in current liability. It was shown in current liability. Now that should be shown in short-term borrowing. Okay. So how much will you count in borrowing? Complete thing. It doesn't matter. CARO is not concerned with the long-term borrowing or short-term borrowing. If 25 lakh is appearing in long-term borrowing and 5 lakhs is appearing on short-term borrowing, doesn't matter. We will consider both inclusive. Okay. We will consider both. Borrowing will be 30 lakhs. 30. Very simple. Will it cover short-term loans? Of course, yes. That's what we discussed. It will cover long-term as well as short-term. Overdraft facility. Suppose we have a company has taken overdraft facility and it is on the and FD is given as security. What you have given as security doesn't matter. What you have given as security doesn't matter at all. Okay. Moment you have taken a borrowing, it's a short-term borrowing, it will be counted. Even if you have given FD as a security, it will not have any change. It will be counted. So we are going to count secured as well as unsecured borrowings. Then private limited company is taking borrowings from Mukesh Bhai, Aziz Premji, ICICI Bank. Guys, only borrowings from banks and financial institution. Borrowing from Mukesh Bhai will not be counted. Aziz Premji will not be counted. ICICI Bank, yes. IFCI, yes. They will be counted. And if that borrowing is only 15 lakhs, it is not exceeding 1 crore, there is no breach of condition, exemption will continue, provided other conditions are fulfilled. Whether loan from NBFC will be counted, loan from all the banks and NBFCs will be counted, even this will be counted. Okay, yes, it will be counted. We are not discussing whether NBFC will get exemption. No. We are discussing when it comes to borrowings, whether borrowings from banks and financial institutions will be taken, in that whether NBFC will be considered as financial institution. Answer is yes. So private limited has taken CC. CC means cash credit limit of 300 lakhs. That's the maximum limit. That's the maximum limit of 300 lakhs. And the actual loan, that actual amount which is outstanding is 80 lakhs. What would you consider? Will you consider the maximum limit or the actual loan? We will definitely consider the actual loan. We will definitely consider the actual loan, and 80 lakhs will be considered and not 300 lakhs. Loan during the year rose to 1.6 crore, but it was paid. It was nil as on balance sheet date. What will happen? When it comes to loan, we have to see status anytime during the year. Anytime during the year. If it crosses 1 crore anytime during the year, condition is broken. Okay. Condition is broken. Condition is broken. And if condition is broken, there is a breach. Condition is broken, there is a breach. Okay. and they will not get the exemption. Whether revenue will include other income. So the word used is total revenue. Why they have used total revenue? Total revenue itself means your turnover, sale of goods and services plus other income. So yes, total revenue word will include other income. Now next is private limited company has a sale of petrol 4 crore rupees. Sale of petrol 4 crore rupees. Okay. So now we are discussing what will come in total revenue. Whether sale of petrol, yes. Sale of goods and services will come. 4 crore will come. Sale of services 2 crore. Will it come? Of course, even that will come. Yes. Sales return. Now the interesting thing is sales return is 1.5 crores. Out of that, 0.5 crore is of previous year. So there's a sale return of 1.5 crore during the year. 0.5 crore is sale of previous year. Sale happened in previous year, returned in the current year. And 1 crore is sale happened in the current year, return in the current year. How much sales return we will minus? Complete 1.5 crore. Complete 1.5. It doesn't matter when the original sale was done. See, when you pass sales return entry, sales return account debit to debtor account credit. Do you ask this sales belong to which year? Whether entry changes, whether accounting entry changes, if it's a previous year sale or current year sale, answer is no. Complete sales return will get minus, you will get deducted. 0.5 crore, the given is only for confusion. Then they are saying excise duty. Okay, what will happen with respect to indirect taxes? See, it's very simple. Okay, whether indirect taxes will be included or not, it depends what is the method of accounting they have adopted. Every business organization has their method of accounting with respect to indirect taxes. There are two methods of accounting with respect to indirect taxes. One is inclusive method and the other is exclusive method. Now, what is this inclusive method? Inclusive method says that the moment you pass sales entry, that time itself you consider that you pass entry with the complete amount to sales only. Cash and account inclusive means cash bank account debit to sales account credit complete 118. Even GST is included in this. After the month end, after the month end, as month comes to an end, you compute what is the total amount of sale for the month, do reverse calculation, and then you transfer sale account debit to IDT payable and pay it to the government. If entity is following inclusive method of accounting and they exclude IDT later on, wherever payment is to be done, okay, they do this, then we should include IDT in our sales amount. It should be included. So if the method of accounting is inclusive, include IDT while computing turnover and total revenue. Then if they are following exclusive method, that means the point at which sales is recorded, that point itself they segregate IDT payable. That point itself they segregate IDT payable. That is exclusive. If they are following exclusive method, exclude it in computation. Simple. But then in problem, generally they don't specify method of accounting. They only specify whether the IDT amount is included in the given figures or excluded in the given figures. They are silent about the method of accounting. In practical life, no one would like to hike their turnover and get more tax obligations. So in practical life, generally people follow exclusive method. The moment entry is passed, and in this world of technology, it's very easy. So the moment entry is passed, they segregate it and transfer it to IDT payable. So in practical life, exclusive method is famous. We should assume that and follow it. Now in this our problem, they are silent about method of accounting. So we'll have to use exclusive method because that's what softwares do. At the moment sale is booked, they exclude it. We have to assume exclusive method and we have to deduct it. To complete 75 lakhs will be deducted from the sales because we are assuming exclusive method. Interest on investment, that is a part of other income. It is part of other income, it will become part of total revenue. Then interest, profit on sale of investment, Even that is part of other income that will be taken. Scrap sale, yes, even that will be taken. GST, same, it is the IDT payable. We will assume exclusive method and we'll exclude it. So after doing all these adjustment, it is 4.45 crore. It is much below 10 crores. It is much below 10 crores. Rectify that. It's much below 10 crores. So CARO is not applicable. For sure, it's not applicable. Small company definition we already know and we have compared it. Okay, that both covers private companies, both cover limited as well as unlimited companies. We have seen that we have compared. There in holding subsidiary, public company should not be there. Here no no holding and holding and subsidiary, no section 8, no governed by special act. There we know paid up capital limit is paid up capital and reserves is 1 crore. Here paid up capital limit is 2 crores, which can be increased to 10. And there we have total revenue 10 crore. Here it is turnover of last year 20 crores, which can be increased to 100. If a company is eligible either for exemption number 5 or exemption number 6, any of them, they will get the exemption. No need to fulfill all the conditions. We have seen the difference also. What is the difference between both the exemptions? Quickly, let's see the charts which we have already discussed through cases. We have discussed that all the 4 conditions should be satisfied. Private limited will get exemption, unlimited will also get exemption. We have to check wherever things are silent as on balance sheet date. And if a foreign company is involved, it doesn't matter. It doesn't matter. A foreign company is involved, they will not get a public and private condition will not be broken. They will get exemption. While computing paid up capital reserves, equity will be considered, preference considered, policy in arrears will be deducted. Of course, we have to compute paid up capital and reserves. Share forfeiture, yes, it will be considered. General reserve, P&L balance, debit balance, premium, all of them. We have seen these cases. Policy in advance should not be taken. It's a liability. Share application, liability. No. Fictitious asset should not be deducted. We are not computing net assets. We are simply computing paid up capital and reserves. Fictitious assets should not be deducted. When it comes to loans, loan from Nbfc, yes. Interest due, yes. Funded facility, yes. Payable within 12 months, yes. Short term, long term, yes. Secured, unsecured, yes. Secured by anything, doesn't matter. CC limit, actual loan only. Loan process 1 crore but repaid, it will be considered. Loan from individual, no. Unfunded facilities, still. Unfunded facilities, no. Interest accrued, no. When it comes to total revenue, goods and services, yes. Sales return deduct completely. IDT inclusive method. Sale of scrap, yes. Interest dividend, yes. Profit loss, yes. IDT, if it's an exclusive method, we exclude it. Advance received, it's not a revenue yet. Now guys, let's see shortcut. Shortcut to remember. Shortcut to remember CARO 2020. Okay, it's a very simple shortcut. It's a story. The story is very simple. Just imagine that you have become a chartered accountant. Okay, and you see your result on the laptop and you are happy, you're jumping. Okay, and let's see now. After you become chartered accountant, now first thing, just focus on the images. It's an image recognition technique. Image recognition technique. Focus on Flipkart. Yellow color logo. Okay, yellow color logo, Flipkart. So you go to Flipkart and you do a lot of shopping. You're now a professional. So all the professional attire, you're doing a lot of shopping. Then you go to a airline, Indian Airlines. Now you're chartered accountant, you will fly. You're booking ticket to 3-4 metros so that you can go and give interviews. Okay. Then next, you go, now you have planned that you are visiting 3 cities. Then you should know whom to contact. You go to LinkedIn and find out whom to contact in these cities. Okay. Then you go to live.com is an email service and you start putting mails to people that okay, I have qualified, this is my CV, curriculum vitae, resume, this is my resume, and I wish to join your organization, I'm applying for it. Then Dropbox is the place from where is a cloud service from where things are getting attached, documents are attached. Okay, finally you are on the airport and you know everything, but then you are not aware about the current affairs. You go to CNN website to get the current affairs. And finally, for relaxation, you listen to Spotify. Let's see. Very simple, straightforward. After becoming CA, yellow color, Flipkart. White color, aircraft, Indian Airlines. Then blue color, LinkedIn. Then multicolor, live.com emailing. Blue color box, Dropbox. Red color, CNN. Green color, Spotify. Image recognition is extremely important. Now, Flipkart is for fixed assets, property, plant, and equipment. Indian Airlines is for inventory. LinkedIn is for loans given. Live.com is for loans given under section 185, 186. 185, 186. Dropback is for deposits taken. CNN is for cost records. And Spotify is for statutory dues. So fixed assets, inventory, loans under 185, 186, deposits taken, cost records, statutory dues. These are 7 websites. Then these are the companies you gave your interview. Focus on the images, guys. Number will come automatically. Don't focus on numbers. Just focus on images. We are very. So we have a logo, and the name written. That is Tata Steel. Then blue and yellow. That is LIC. Then in light in you can say narrow font, Infosys. Then we have in bold font, Pinolex cable, blue and black. Then we have black and red, Network 18. Then we have golden and black, Reliance. And then finally, we have Indian Oil. So just focus on the logos. First, we have Tata Steel. Then we have blue and yellow, LIC. Then we have Infosys. Then we have Finolex and Finolex cable. Then black and red, Network 18. Then golden and black, that is Reliance. And finally, we have written in between Indian Oils. Tata Steel is for transactions, unrecorded transactions. Unrecorded transactions. LIC is for L for loan repayment. Then Infosys is for IPO, FPO, preferential allotment, private placement. IPO, FPO, preferential allotment, private placement. Okay. Then Finolex is for fraud reporting. Network 18 is for Nidhi company. Reliance is for related party transactions. Indian Oil is for internal audit. So we have Tata Steel transaction, LIC, loan repayment, Infosys, IPFPO, Finolex cable, fraud, Network 18, Nidhi company, Reliance, related party transaction, Indian Oil, internal audit. We have 7 websites, then 7 companies, company logos, 7 company logos. 7 and 7 is 21. See, numbers will come automatically. Suppose I say LIC, there is all loan repayment. So 7, 8, 9. 9 number is the clause. Clause numbers will get automatically if you can retain the images. Then finally, the last one, food. Okay. Food. So what are you having? You see first some nuts. That's cashew nuts. Okay. Cashew nuts, almond, etc. Then you see some fresh carrots. Then you see chiku. Okay. Then these are good things. These are all fruits. These all are fruits. But then some bad things. You see sweet dish. That is rabdi. You see alcohol. That is madira. You see chocolate. And find the superfood. Avocado. Now nuts is for comment on non-cash transaction. Nuts, non-cash transaction. Carrots, certificate of registration from RBI. Chiku is about cash losses. Rabdi is about resignation of statutory auditors. Madira is for material uncertainty on the company. Chocolate is for CSR. Avocado is for adverse remarks qualifications. Guys, it is 7 websites, it is 7 companies, and 7 food items. Now let's see clauses. Guys, CARO clauses are drafted in such a manner that weaknesses of the companies come out so that corrective action can be taken by shareholders or government authorities or all concerned people. Let's see. So now, first is fixed assets. auditor has to report 5 things with respect to fixed assets regarding what company is doing regarding fixed assets. Let's see. So he has to report on 5 critical matters. Number 1, whether company is maintaining proper fixed assets records. That means proper fixed asset register where fixed assets should be described. Quantitative detail should be given. How many machines, how many cars are there, how many equipments are there, along with the location, so that it is very easy to trace the fixed asset. So whether auditors report whether company is maintaining proper fixed assets records and registers, and record should also be maintained about ITA, that is intangible assets. Second, whether company is conducting physical verification of assets within reasonable interval of time, and after physical verification is conducted, when we match physical assets which are physically present with assets as per the records, whether they agree to each other, whether there is a material discrepancy, that means any material difference between what we have physically and what we have in records. So second, we have to comment on physical verification. Okay, we will talk about some more things also, but first let's see the basic things. Whether proper fixed asset records are maintained. Secondly, whether physical verification is conducted within reasonable interval of time. Then next is, as I said, we will see details. We'll see further details in each of these points. Then whether title deeds, that means ownership records of immovable property, are in the name of the company. If not, see, if fixed asset belongs to company, ownership document, legal title should be in the name of the company. If not, we have to provide the details. We need to comment whether title deeds, ownership records of immovable property, excluding leased assets. Of course, if asset is leased, we are not the real owners. Lessor is the real owner. Leave those assets. In others, it should be in the name of the company. If not, details need to be given. Describe the asset. Is it land? Is it building? What's the gross value? In whose name it is? Whether that person is a promoter, director, relative, employee, and for how many years it has been like that. What is the reason, and whether there's any dispute. We need to give details which fixed assets are belonging to company, present in the balance sheet, but not in the name of the company. Third, we need to comment whether company has done revaluation during the year. If answer is yes, whether it was conducted by a registered valuer. If answer is yes, a registered valuer. Okay. And then next question, if the revaluation is 10% or more of the each class, we need to give amount. We need to give revaluation amount if it is a big thing. If it's 10% or more of each class of each class of asset. So if it's a big revaluation, then amount is required. Then further, whether company is having any, whether it's about Benami property. What is Benami property? It may happen that, let's take an example of politician, that politician has money, asset is purchased in the name of the personal assistant, PA, in the name of the driver, in the name of the watchman, in the name of the gardener. So property is purchased in their name, but politician is the real owner. He is giving money. He is having control over it. He is having original documents. That's called Benami property. Benami property means property is in name of the one person, but real owner is someone else. So to identify such cases and take action, we have Benami Property Act. Whether any case is pending against the company under Benami Property Act, and whether it is disclosed. The new Schedule 3 says that a proper disclosure should be given in notes to accounts regarding pending cases under Benami Property Act, whether it is properly disclosed in financial statements. So guys, 5 things need to be reported. Whether fixed asset records are properly maintained, whether physical verification is done within reasonable interval of time. Next, whether immovable property belonging to company is legally on their name. If not, give details. Whether revaluation is conducted is by registered valuer, and amount only if the change is huge. it is 10% or more of each class of asset. And then Benami Property Act, whether any case is pending and is initiated pending under Benami Property Act. See, these charts are extremely good. They cover all the details from the clauses. No need to go and learn these clauses. It is not required. It is not required, guys, and it will be difficult and not required. As I said, if you remember these 5 points, it is good enough to solve any case, to solve cases, and to write good answers. Further, we have given analysis. Let's see this analysis. That's important. First of all, maintenance. First is regarding maintenance of records. We already know about maintenance. Now, let's see further details about each point. Now, we know that we are supposed to comment on 5 things. Now, let's talk about maintenance. Let's further go in detail. Are we supposed to maintain fixed asset records for all the types of fixed assets, whether acquired by us, whether constructed by us, or whether taken by finance lease? Answer is yes. We have to maintain record for all the types of assets. These assets may be acquired by us, it may be constructed by us, or it may be taken on finance lease. If any asset is taken on finance lease, then we know that finance lease is a lease for namesake. In reality, lessee is the real owner of the asset, real owner of the asset. In fact, lessee has purchased the asset by taking finance, by taking loan. So asset should appear in the name of the asset should appear in balance sheet of the lessee. Okay. So guys, it's simple, straightforward, that record should be maintained for all the types of fixed assets, whether it's constructed, acquired, or whether it is taken on finance lease. Then it's interesting whether fully depreciated, fully amortized, fully impaired asset should be covered in the fixed asset register. Of course, in fact, it is very important to cover them. If a value of the asset has become zero, it's very easy to misappropriate that asset, and no one will come to know about it. No one will come to know about it because value was already zero. So keep in mind, even these kind of assets should be there in the fixed asset register. Now, let's talk about location. So first was which cases, all the types of cases should be included. Location. Yes, we have to mention location of the asset. What if assets are moving assets? It can happen that assets are moving on continuous basis. They are JCB machines, they are trucks, they are vehicles, they are moving on continuous basis. If the asset is a moving asset, then in fixed asset record, it should be written it's a moving asset. And you should maintain separate records and maybe update that on weekly basis, fortnightly basis, monthly basis, and write the location of the asset. Okay. Then next, what if asset is at the home of the staff? Whether the address of the home of the staff should be written in the location? Answer is no. If asset is at the home of the staff, and then in that case, you simply write name of the staff and his designation. Simply explain in whose home you are going to find this particular asset. Okay, managing directors, CFO, whole-time director, whatever it is, write the name and designation of that person. So when it comes to records, just ensure everything is included, and also ensure that location should be properly written in the fixed asset register. So there is a moving assets, and what if it is at the home of the staff? Next point is physical verification. If annual verification is done, that is definitely within reasonable interval of time, no problem. But guidance note says that this can be increased. The gap between two physical verification can be more than 1 year. It can be more than 1 year. It can be 2 years. It can be 3 years, and still it will be considered reasonable. If the assets are spread across a big area, there are very less chances of misappropriation because of size and weight of the assets. Okay, so it may not be necessary that we perform physical verification every year. It may be done once in 2 years, once in 3 years. If that is done, if physical verification is going beyond 1 year, still up to 3 years it can be reasonable. Auditor need to study, analyze. Up to 3 years it can be reasonable. But then auditor will have to mention this in report, that frequency is once in 2 years, once in 3 years, but we consider it as reasonable, acceptable interval of time. We have to mention, moment you go beyond 1 year, we have to mention this in our audit report. Now regarding title deeds, we already know title deeds, it tells who is the owner of the asset. Okay. And then they explain this generally happens when a proprietor is converted to the company, partnership is converted to the company, there's an amalgamation. That is the time all these things happen, that assets are again in the name of some assets are in the name of some other entity, the entity which was closed. If documents are lost, see certified copies. First, if management says that we don't have original copies, first take the copy of FIR. If such an important document is lost, company to do FIR, so see that. They must be having certified copies, see that. And then take written representation. If these three things are done, it is fine, it is good enough. When it comes to revaluation, okay, see, fair valuation of fixed upon first time adoption of Ind AS not to be reported. First time when Ind AS is applicable, a lot of things need to be changed. We are not targeting and focusing on that particular aspect. Okay, we simply want to know about revaluation. Now, retain a copy of valuation report at registered valuer. Using such report will be covered in SA 500 and not SA 620. Now, listen, guys. See, registered valuer is an expert and management expert. Management expert is covered in SA 500 and not 620. So, obtain that document report also. Benami transaction, whatever you call it. Earlier, it was Benami Transaction Prohibition Act (BTP), and then it became BPT. PBPT, Prohibition of Benami Property Transaction Act. Whatever, if case are pending, details should be given in the CARO report. Now, various standards. We have SA 250, 501, 560, 580. If auditor comes to know about their suspected or actual non-compliance of Benami Property Act 9. So, along with the regular audit procedure, SA 250 will apply because it's a legal matter, it's a litigation. So, to analyze, evaluate it, auditor can apply 250. Again, 501, apply if the auditor comes to know litigation rate to 501 is about litigations and claims, about 250 is about legal matters, even that will get applicable. 501 litigation, that will get applicable. 560, apply if order is initiated under prohibition of PPT Act under year end before financial statement finalization. If things are known to us after signing but before finalization, definitely we can take corrective action. 580, we take written report at various places, again in this case. So these are the standards which get attracted. Moment to enter into legal things, 250 get attracted. Litigations, 501 get attracted. Subsequent changes, 560 get attracted. Written representation, 580 gets attracted. Now, next clause is Indian Airlines, that is inventory. See, with respect to fixed asset, we commented on 5 things. But when it comes to inventory, we have to comment only on 2 things. Okay, guys, all the important clauses, I have marked it as important. See here, 3 stars are there. So wherever you find these 3 stars, these clauses are important, and you should also mark them. On the same lines, clause number 1 was marked important. Let's see inventory. In inventory, we have to comment number 1, whether management is conducting physical verification within reasonable interval of time. This point is similar to what we have seen in fixed asset, but there is a difference. Okay, the difference is in fixed asset, they say that comment whether there is a material discrepancy, whether there is any big difference. Material discrepancy, you apply your judgment whether there is a big difference and comment on it. Here they have quantified. If discrepancy is 10% or more, 10% or more, then detail should be given. This is properly, not property, properly. whether discrepancy of 10% or more are properly dealt. Whether so we need to comment whether there's a big difference of 10%. If the discrepancy, so we need to first tell whether there is a discrepancy which is 10% or more for a particular class of inventory, say for raw material, for WIP, for finished goods, and if it is there, whether it is properly dealt. There's a difference. Okay, so here also we have to comment on reasonableness of physical verification, and then the changes that we have to comment whether there is any discrepancy of 10% or more, and if it is there, whether it is properly dealt. Second is very interesting and important. If company has taken working capital limit for a working capital loan, definitely working capital limit is taken for working capital loan from bank or financial institution, and that is more than 5 crores. That means a company has taken a big limit, a big loan for from a bank and from banks, financial institutions for working capital. Okay, in this case, what happens? Generally, company when it takes this working capital limit, working capital loan, they generally give their current asset as a security. So further, if they're taken working capital loan of 5 crores, more than 5 crores from banks and financial institution on the basis of current assets, on the base of current asset, generally it is taken on the basis of current assets only. But then they have specified it, because if that is not the case, if it is taken on the security of something else, this particular point will not be applicable. So if company has taken working capital loan more than 5 crores on the base of current assets, then it is a normal thing that company has to on quarterly basis submit stock statement. In that, this provide what is the value of the stock they're having, value of the debtors, creditors, and other details as required by the bank. We have to comment as an auditor whether information in these quarterly returns and other statements which are given to the banks, whether this information agrees with books of accounts. So no one was checking this information, because this information is being sent to the bank. There is no law, there is no essay which says that you have to check this information. Here, auditor of the company will check whether information sent to the bank is agreeing with books of accounts and has to comment on it. Whether the answer is yes or no. So inventory comment on two things: whether they are conducting physical verification within reasonable interval of time, and if they and tell us is there a big discrepancy of 10% or more. If yes, it is properly dealt. Next, if they have taken working capital loan more than 5 crores from banks and financial institutions on the basis of security as current assets, then whether the quarterly returns and other statement which are sent to the bank, whether information agrees with the books of accounts. Now, further, if we analyze in reasonableness, again, in reasonableness, there is a change. When we studied this point with respect to fixed asset, we understood that okay, within 1 year is definitely reasonable, but up to 3 years is also considered reasonable if it is justified, and you have to mention this in report. It is once in 2 years, but it's reasonable. Once in 3 years, but it's reasonable. But when it comes to inventory, it says that it should be once in a year is reasonable. It should be at least once in a year. Once in 2 years will not be considered reasonable in case of inventory. Once in 3 years will not be considered reasonable in case of inventory. Why so? Why? Because inventory every year at year end, you have to pass closing stock entry. So at least once it is required. Then they say, when we talk about class of inventory, that if the discrepancy is 10% or more, discrepancy is 10% or more for a particular class of inventory, tell us that and whether it's properly dealt. What is the class of inventory? Raw material is a class of inventory, WIP is a class of inventory, finished goods is a class of inventory, assets which are acquired for sale, for resale, that is class of inventory. That's simple. Discrepancy should be on net basis. That means at some places there is extra stock, at some places there is less stock. So net, what is the impact? Then we have studied this. If working capital is taken on the basis of current asset as a security, then only reporting will be required. Otherwise, this reporting won't be required. Next is regarding loans, majorly loans, investments, guarantee, security. Okay, given. Let's. It's very interesting clause. lot of things need to be reported. So A to F, A, B, C, D, E, F, 6 things need to be reported. So it is one of the clause where reporting is in 6 points. Okay, one of the rare clause in which the reporting is in 6 points. Rest of the other clauses you will find that there's only 1 point to be reported or 2 points to be reported, maximum 3 points. Now here 6 points are to be reported. So I will say that it is one of the big clauses amongst the CARO. And then we have 5 point reporting in fixed assets. Okay, what are we supposed to report here? Now, first, we need to report what is the aggregate amount of loan given, aggregate amount of loan, aggregate, total due. How much loan is given, guarantee is given, security is given in aggregate within the group. That means subsidiaries, joint ventures, associates. So we are talking about the company, how much money and resources they are flowing on aggregate basis within the group to subsidiaries, joint ventures and associates, and how much is outstanding, how much is given during the year and how much is outstanding within the group, and also how much is given and outstanding other than outside the group, that is subsidiary, joint venture, associate. So first thing is very simple. We have to comment in aggregate how much loan, how much guarantee and security is given and outstanding as on balance sheet date within the group and outside the group. When I say group, that is subsidiary, joint venture, associates. So give information how they are flowing their resources within the group and outside the group. Now keep this in mind. This particular point will not be applicable if principal business of the company is giving loans, guarantees and securities. If that is their principal business, okay? So if it is a banking company, it is their principal business to give loans. This point will not be applicable to them. As such, CARO is not applicable to banking companies. Let's talk about NBFCs. If NBFCs, CARO is applicable to NBFCs, but then this point will not be applicable because their principal business is to give loans, guarantees and securities. Next, so first tell what is the quantum of loans and guarantee security they are doing. Next, whether any of the loans or guarantees, securities, including investment is harmful to the interest of the company. So this is the only point where they talk about investments also. Is it prejudicial harmful? That means you are giving loan at 2% where the market rate is 12%, 14%, 15%. It is harmful for the company. You're going loan for 100 years. On the other hand, market is giving for 10 years, 20 years. It is harmful for the company. You are not taking adequate security when others are. Again, it's harmful for the company. So comment on prejudiciality. Okay. So first comment on aggregate, how much amount is given. Okay. And then whether it is prejudicial. So I will make this as a key point here and prejudicial as a key point here. Then next, whether repayment terms are specified. Generally they are specified, but then specify with respect to all loans which are given, whether repayment terms are specified. Okay. And further, if they are specified, so clearly tell, okay, out of 10 loans, for 9 it is specified, or 1 it is not specified. Now for the 9 which is specified, whether there is a regularity, whether company is regularly recovering money from those loans. So it is about repayment, whether repayment terms are given, and if they are given, specify how many it is given, how many it is not given, and for those it is given, whether recovery is regular or not. Next, if amount is overdue more than 90 days, whether company is taking proper steps of recovery. Overdue more than 90 days, proper steps of recovery. So proper steps of the recovery will be sending communications to the borrower that, listen, amount is overdue, you're supposed to pay, otherwise we'll have to take action. Sending communications to the person, then stopping transactions with them is again step. Meetings are the step. Then bringing out security for sale is the step, sending legal notice is the step. So whether company is taking proper steps of recovery. Okay, this is the 4 points. First, give aggregate amounts. Then whether things are prejudicial for the company, harmful for the company. Then talk about repayment terms and regularity. Then talk about steps of recovery if amount is overdue more than 90 days. Then next, when loans fall due during the year, whether loans are renewed, extended, or fresh loans are given. So how many time it is? So we need to give it information about the situation where we were company was supposed to get loan money. Loans have fallen due. Companies were supposed to recover money from loan, but then company renewed the loan. So loan was given for 2 years, and they were given it was renewed for 2 more years. It was extended for 2 more years, or a fresh loan was given to repay the old loan. So this is extraordinary help. Whether company is giving extraordinary help in the form of renewal of loan, extension of loan, fresh loan. So how, if loans are becoming due during the year, and whether they are giving this extraordinary help, we have to give we have to give, okay, what is the aggregate amount? What is the aggregate amount? So for what amount of loans are renewed, extended, or fresh loans are given during the year? What amount of renewals, extensions, and fresh loans are given? So at what volume this activity is happening, and also percentage of loan given during the year. Percentage of loan. So percentage of loan given during the year. That means suppose renewals, extension, fresh loan amounts to, so the renewals and extension, fresh loan amounts to say 500 crores, and total loans given during the year, including total loans given during the year, including this 500 crore, is 1500 crores. That means out of 1500 new loans given, or extensions given, or renewals given, 33% is 33% is for old loans. Old loans. That means company simply wants to hide how old loans are not recovered. Is a very clever technique to hide that how old loans are not yet recovered. Old loans are continuing and continuing. This is called evergreening. Evergreening. When companies wants to hide that they are not regularly recovering their loans, hide that loans are not getting recovered, they simply renew, extend, and give fresh loans to such people and hide it. So in this clause, we have to give details that such kind of malpractices, what is the amount, what is the total amount in such malpractices, and it is how much percentage of total loans given during the year. Further, this point is also not applicable. I've just made the arrow. This point is also not applicable if giving loan is regular business of the company. So this won't be applicable to NBFCs. Further, as per guidance note, it will be good if you break it up, that how much of these loans, this evergreening of loans is done for subsidiaries, for associates, and for others. We'll see CARO report, actual CARO report. I will show you the examples for the same. Okay. Then the last thing, so just note it down here that further you break it up, how much to subsidiaries, associates, and others. It is given guidance note. Then see, the dangerous loans are on demand. On demands or no repayment terms. Okay. So whenever see, if company has given loan when there are no repayment terms, it's a very sad state of affairs. You are not mentioning how you are going to get your money back, by what time you are going to get your money back. So sometimes they write on demand. On demand. Whenever we'll ask for it, we'll get it. Again, that's not a very, very good financial management. So giving on demand loans or not having repayment terms is not a good financial management. So we need to specify what is the aggregate amount. What is the aggregate amount aggregate amount of loans where there are no repayment terms or on demand, and what is the percentage, what is the percent of total loans of the company, what percentage are on demand or without repayment terms, then further specify it, how much of such loans are given to promoters and related parties. Okay, let's see. So we have seen three clauses and I'm showing you how it appears. So when it comes to fixed assets, there were 5 points. There's maintaining proper records. This is report of Reliance Infrastructure. Proper records, there is a, you see, when it comes to proper records, they have commented. When it comes to reasonable inter or physical verification, they have commented. In Reliance Infra, they do it once in 3 years. Then when it comes to ownership deeds, they have commented that there is a land of 18 crores and title deeds are not in the name of the company. Whether it's a name in the name of the promoter, directors, no. Since when this is there and what is the reason? Okay. Then they are further explained. So whether there is revaluation, there is no revaluation. No revaluation. Whether any proceedings under Benami Property Act, there is no proceedings, no cases pending. So 5 points. Then 2 points of inventory. Regarding physical verification, yes, reasonable interval of time. Whether there is a mismatch, if the working capital loan is given. So they say yes, we have taken working capital loan on the base of current asset security, and we have given the information, and it's in agreement. It is agreeing, no problem at all. It is agreeing. The information which is given, it agrees with books of accounts. Then this is the point, the 6th point with respect to loans given. So in the first point, we have to give aggregate details of loans and guarantees. So during the year, how much loan is given and outstanding to subsidiary, joint venture, associate. If you see 216 crores is given to subsidiaries, joint venture nothing, associate nothing. How much is outstanding? So when it comes to guarantees and loans, this is the total amount which is outstanding. Joint venture nothing, associate there are amounts. Then is it prejudicial? So auditor has commented prima facie not prejudicial. Then we have to, then they're talking about repayment. So first we have to comment about the aggregate amounts. After aggregate amounts, we have to comment about whether things are prejudicial. Okay. After prejudicial, we have to comment that whether repayment terms are given. Repayment terms are given. So they are saying yes, repayment terms are given and they are generally regular. They are generally regular. Generally, we are getting money on regular basis. Except there are some matters, and the reason is explained in base of disclaimer. There's some issue with the with EPC company, and they are saying that there's a disclaimer. We cannot comment about that. We are unable to comment for the reasons described therein, where the repayment of principal of 4,000 crore net of provision and payment of interest of 400 crore is delayed from 31st March, that is 730 days. So there is only one case. There's only one case where repayment is not regular and those details are given. Those details are given. We cannot comment fully because there's a lack of information also. We explained in the basis for disclaimer opinion. Okay. So the main report is having disclaimer and they're saying the reason is explained there. Anyways, so we have to comment whether we are regularly. So Reliance Infra is recovering money regularly except in one case. Whether any amount is overdue more than 90 days, more than 90 days and proper steps of recovery. There's only one instance. Again, the same EPC company, they are not getting the money. Everything else is fine. Then interesting about evergreening. We are talking about evergreening. Let's see this evergreening thing. How much loan is renewed, extended, or fresh loans are given. So this is the 547 crores of loan is renewed, extended for subsidiaries, 1,000 crore for associate, 41 crore for others, and it accounts for how much percentage? So it accounts for 39% of total loans Out of total loans given, 40% is just renewal. In case of associates, it is only renewals. Okay, 58% and 2.14%. So in fact, 40, 60, almost 100% of loans given during the year are renewals, extensions, almost 100%. Okay. Then what is the aggregate? They're saying no amount is repayable on demand or without any repayment terms. So at least in point F, they don't have anything to say, anything negative. Again, guys, 6 points. I've marked it important. First, give details, aggregate basis. Then, is it harmful? Then, specify about repayment terms and its regularity, steps of recovery. Then, about the renewals extension in percentage basis and how what percentage is what percentage uh, of the loan is on demand and repayment. Okay. Let's see further analysis. If we go for further analysis, point number A Point number A is not applicable if the principal business is financing. So it's not applicable to NBFCs. Fine. Point number A. Then a very interesting and important point, guarantee include only those which are given to banks and financial institutions. We are not bothered about all the guarantees given. Only those which are given to banks and financial institutions is a very important point. If the loans are squared up means loan was given and during the year it was recovered. Where squared up loans will be covered, of course, all the loans given will come here. All the loans given will come here. When it comes to prejudicial, we know that it's about interest, security, tenure. Further, sometimes loan is given to employees on concessional rate. If it is as per policy of the company, for the benefit of the employees, it is absolutely fine. It will not be considered prejudicial. It is understood. If you're giving it to your employees, it is an incentive for them. It is fine. Then repayment is nothing special. We simply whether repayment terms are specified, and we have to talk about regularity. Steps of recovery only when amount is overdue more than 90 days. Amount is overdue more than 90 days, then only. And steps of recovery will be a lot of things: sending reminders, meetings, seizing the transactions, lawyer's notice, auction of securities, etc. Everything comes in legal steps. Just not the everything comes in steps of recovery, just not the legal steps alone. So steps of recovery more than 90 days only when there's nothing special and steps are given. Then for loans which are fallen during the year, not applicable companies, again, 2 points. Point number A and then point number E are not applicable. Not applicable if the principal business is of giving loan. And this thing is called evergreening. Companies are hiding their bad loans by continuously renewing them, extending them. This is called evergreening. Just an example, suppose there was a loan of 100 in the opening. 3 loans were given, 200, 300, 400. So 200, 300, 400, that is 900. And company has extended tenure in respect of 2 loans, 100 and 200. So out of 900, opening loan was 100, 900 was the loan given during the year, 900 crores maybe. And then out of that 100, 200, 300 is the evergreening. So 33%. Point is, we will take only 100 plus 200 renewals and total loans during the year 900. We will not take opening balance. So we have to calculate the percentage keeping in mind loans given during the year and not just don't include opening balance basically. Now this is next is the example in guidance note that with respect to loans where there are no repayment terms or terms are on demand. So what is on demand? 200 crores. 200 crores is on demand. Aggregate amount of loans on demand, aggregate amount of loans given by the company on demand is 200 crores. Then without repayment term is 100. So total 300. So we have to give percentage. So 30, suppose total loan is 1000. Total loan is 1000. 30% of the loans are either on demand or no repayment terms. Then how much of that is given to promoter? How much on demand is given to promoter and related parties? How much is given without terms to promoter and the related parties, their total? And again, as a percentage of total loan. So 10%, 10% of total loan is given to promoter, which is on demand or no repayment terms. 5% is given to related parties. We can understand that there are 30% such loans, and out of that 10 plus 5, 15% is given to our promoters and our related parties only. This is the way how company operates. Bad corporate governance, just thinking about benefits of their own promoters and not the stakeholders as such. Further, when we talk about related party, AS 18 and SA 550 will be applicable. Now next, I have not marked very important. In this particular, we simply need to tell if company has given loans, to directors, okay, whether they have complied with section 185, and if company has given loan to other given loans apart from these, given loans as such, whether they have complied with section 186. If company has given loan to directors, whether they have complied with 185. If they have given loans as such in general, they have complied with 186. If there is a non-compliance, give maximum outstanding and closing balance. How much was outstanding during the year and the closing balance if there is a non-compliance. If there is a non-compliance, we need to give details in which particular to which particular director there was a non-compliance, maximum outstanding and closing balance. And when it comes to overall loans, if there's a non-compliance of 186, give the amount and again a closing balance. How much is outstanding as on year end? Okay, let's see. If you see these details, so it is simply we need to comment on compliance of 185, 186. 185 is with respect to directors, and 186 is in general about loans and investments about by the company. If there is a non-compliance, then only we need to give details. Now this is interesting. This is an example. If there's a non-compliance of 186, now it is this table is having key points of 186. See, in law you study this. In law you study in detail. We are not expected to know these things in detail. Just an overview. So when it comes to investments, investment should not be more than 2 layers of investment companies. That means if it's A Limited, A is investing in B, that is one layer. B is investing in C, that is second layer. Fine. Investments should not be more, when you make investments, investment should not be more than 2 layers. Okay. So if it is more than 2 layers, it's a non-compliance of 186. We will report to which company such loan was given, what is the amount which was given, and what is outstanding as on balance sheet date. If there is a default of 186, we will give details with respect to which loan there was a default, what was the amount of the loan, and how much is outstanding as on balance sheet date. Then if you cross a limit, if you cross limit, sometimes you need special resolution. If special resolution is not taken, again details need to be given. Then loan rate of the loan should not be below prescribed rate. Prescribed is should not be less than government bond interest rate. Come on, if you're getting risk-free interest from the government, let's not go below that. If you're going below that, again that needs to be reported. A question was asked in exam on this particular point, that loan was given at throwaway rates, even less than how much government bonds earn. That's not a wise decision. It's not a good decision. Okay, that is a non-compliance of 186. It will be reported here. That as such is not very important. See compliance of 185, 186, and if there's a non-compliance, give details. Okay. Next is deposits, that is drop box. We simply need to report whether company is complying with most important law, Companies Act section 73 to 76. Then below that RBI directions, and below that orders, different orders if they are. So are they complying with the law? The most important is law, then the directions, then the orders of the court, below that NCLT, earlier it was called Company Law Board, and then Tribunal and RBI. So we simply have to comment, are they complying with the laws, are they complying with the orders? That's it. If not, give details. Not very important. If not, give details. Then after dropbacks, we had CNN. So we simply, as an auditor, we have to go and do general review. Just have an overview of cost records and cost statements prepared on the basis of those cost records. Just have a general review of overview, take written representation, and then comment whether prima facie, in the opinion of the auditor, cost records and statements are properly made and maintained. So they are made and they're preserved also, properly maintained. Very simple. Go have a general review, obtain written representation, then make a prima facie opinion whether records are properly made and are they properly maintained. Simple. As I said, guys, now these clauses are very, very simple, straightforward. And now comes the very important clause, and that is of statutory dues. Now, what is statutory dues? Payments which are to be made as per law. Payments which are to be made as per law, that are statutory dues. And specifically, it covers dues which are payable to government. So this clause is applicable to statutory dues, payments which are required by law to the government. Example is GST, taxes, indirect taxes, GST, then income tax. Then apart from that, government authority, you have to submit money to government authorities, that is Provident Fund, ESIC. So this clause covers all the payments which are supposed to be made as per law to the government. Okay. Now, they have divided it for reporting in two parts: undisputed statutory dues, where there is no confusion whatsoever that this amount is payable to the government. Okay. And then disputes, where there's a difference of opinion whether the amount is payable or not and how much is payable. When it comes to undisputed, when it comes to undisputed, we have to comment very simple, straightforward, whether company is regular in paying undisputed statutory dues to the government. Are they regular? Is company regular in paying statutory dues, undisputed statutory dues to the government? So we have to comment about regularity. Then we have to comment next, amount which is outstanding, that means unpaid for more than 6 months. Undisputed amount which is outstanding more than 6 months as on balance sheet date, not on the date of signing audit report. No, 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 no. Not on the date of signing audit report, as on balance sheet date. For example, suppose if amount is due on 1st of Jan and 31st of March, it is only 3 months it is outstanding. We are signing on 15th of July. The day we are signing the audit report, it's already due for more than 6 months. But then we don't have to see 6 months on the date of signing audit report. We have to see 6 months on the date of balance sheet. That is balance sheet date. Then when it comes to dispute, we have to make this comment only if amount is not deposited. In many laws, it says that first deposit money and then we will talk about dispute. So if you have already paid the money, no need to report. This reporting will be required only when amount is not deposited. You need to tell what is the nature of the amount. Is it income tax payment or GST payment, excise payment, custom payment, nature, amount involved, in front of which authority dispute is going on, and this amount belongs to which year. So simply nature, amount, authority, and year needs to be given. So we have to give details about undisputed dues as well as disputed dues. Now let's go ahead. Let's go in detail. When we talk about statutory dues, suppose we have to make payment to the government under agreement. We are taking electricity and making payment. We are taking services from railways and making payment. It will not be covered here because it is not payable under law. It is payable under agreement. So it will not be covered here. Okay. Now, Payable to authorities. Yes, if some amount is payable to authorities, now it is like payable to authorities means will be covered as payable to the government, like Provident Fund and ESIC, that will definitely be covered here. But if it is payable to employees, like you have to pay bonus to employees as per POBA, you have to pay gratuity as per POGA, that will not be POGA, that is Payment of Gratuity Act, okay, Payment of Bonus Act, that will not be covered here. Only payments which are payable to government are covered here. They provide the list, it is not exhaustive, this is just an example. So for example, they don't talk about local taxes. Local taxes are also payable as per law. For example, property tax. Property tax is payable as per municipal corporation law, government authority. Even that is covered here. So list given is just an illustrative. It is not an exhaustive list. So as I said, when it comes to undisputed, we have to comment about regularity. Okay. Now this very interesting point. Very interesting point when we talk about regularity. Now listen guys, statutory dues are of two types. One, periodic payments, where you have to make payments on you have to make periodical payments. For example, you have to pay TDS after every month end. You have to pay advance tax after every quarter end. You have to pay GST after every month end. They are called periodic payments. And then there are other payments which are not periodic, which are event based. For example, customs. So if I import, then only I have to pay. Otherwise, I don't have to pay. Okay. So when it comes to regularity, we have to see and consider only those statutory dues which are where the payment is periodic. We don't have to consider those statutory dues which are event based, transaction based. Okay. So whether the income tax, TDS payments, advance tax, GST will be covered. Yes, we have to comment about regularity of TDS, advance tax and GST because they are periodic payments. But what about customs? What about customs duty? Custom duty won't come because it is not a periodic payment. It is event based, transaction based. When we import, we have to pay it. Okay. It is based on transaction. We don't have to pay it on monthly basis, aggregate and pay on monthly basis. We have to pay it for each transaction. But then it's very interesting. Suppose you imported goods are lying in the warehouse of the customs and you have not taken out goods from there. Under Customs Act, you have to pay rent and interest on regular basis. You have to pay rent and interest on regular basis. Okay. Now listen carefully. This rent and interest is as per law. It will be considered it is a periodic payment. It will be considered when we comment about regularity. Let's see two more examples. A person didn't pay any advance tax in the first quarter, second quarter, third quarter because he was not expecting overall profits. But suddenly in the last quarter, in the month of March, he has earned huge money. That's called windfall gain. And then he paid taxes along with interest. Now listen, will it be considered as irregular? If unexpected profits arise and tax is payable on them which we are not expecting, that's called windfall gain. If company is not able to determine windfall gain and pay advance tax for that, it's not company's mistake. Okay, it's not company's mistake. It will not be considered as irregularity. Not able to predict windfall gains will happen, tax will need to be paid. Okay, so this will not be considered as irregularity. Not able to predict and pay taxes on windfall gain, it is not a irregularity. Further, a company, what they do on monthly basis, they are not paying provident fund, but once year comes to an end, they pay provident fund of all the 12 months along with interest. Will it be considered irregular? Yes. See, concept is very simple. In the earlier example, there was no intention to fool government, so it was not considered irregular. In this, there's a clear cut, they have done it purposefully, it will be considered as irregular. So what, you are paying interest at the end, There is a irregularity. So earlier act was unintentional. It is definitely intentional. About undisputed dues, okay, outstanding more than 6 months as on balance sheet date is extremely important. We have seen this point. We have seen the example also. Now, what do you mean by due date? Due date is the date till which you can pay your dues without penalty and interest, without attracting penalty and interest. That is considered as due date. Sometimes it happens that government gives additional time, so thus yes, that will be considered. The date till which you can pay your dues without interest and penalty, that's a due date. If they have granted additional time, fine, consider it. Your due date will be when additional time comes to an end. When it comes to dispute, now government sends a demand order to you that pay tax of 50 lakh rupees. Will that be dispute? No. That is, demand order is not a dispute. Then you ask for clarification. Is that a dispute? No. Even that is not a dispute when you ask for clarification. You say that I am not going to pay it. I will not pay this amount. Will that be considered dispute? Yes. You have a reason, fair reason why you should not pay it. You are having the fair reason. You say I don't want to pay. That is dispute. You go against the government. You appeal to authorities. That is a dispute. There should be, see, appeal means a dispute. Even if no appeal is made, there should be evidence to prove that sustainable, that means a valid appeal can be made. You have grounds, reason where your appeal will sustain, will be accepted, and discussion will be done on that. That will be considered as dispute. So demand order comes, not a dispute. Clarification, not dispute. When you say I won't pay and you have evidence to support it, why it should not be paid, and you think your appeal will be sustained, entertained, it is a dispute. Making actual appeal, dispute. Sometimes there are calculation error and you ask government to rectify it. Is that a dispute? Yes. Because you are asking government to change it. Details of dispute need to be given irrespective of whether provision is made or not. Now, making provision is one thing. Irrespective of whether you make provision or not, details need to, company makes provision or not, details need to be given here. Only if amount is not deposited. Be careful. They will play in MCQ with respect to this. When we talk about amount, penalty and interest, complete penalty and interest should be included in whatever amount you are expressing in this particular clause. See, this is Reliance Infrastructure, and in Reliance Infrastructure you can see that nature, income tax is pending, nature of statute, nature of due, dividend distribution tax, TDS, amount 23 crores, 1 crore, which year, and okay, sorry, this is this is arrears. This is details of amount outstanding more than 6 months. Amount outstanding more than 6 months. So 23 crores is the undisputed amount outstanding more than 6 crores, more than 6 months. Statute is outstanding more than 6 months. Then, and they have specified including interest as discussed. We need to include interest and penalty if any. This is the complete list of dispute. So Delhi sales tax, nature of the due, amount, period, and forum in front of which a dispute is pending. Sales tax, VAT, there's a complete entry tax, income tax. There's a big list. In fact, it's 2 pages full. And intelligently, they are not giving the total. They are not giving the total. Only case by case details are given. Because they know it's going to be good amount and they don't want to embarrass themselves. Now, further essay 250. Now, this is greatness of our institute. In one of the attempts, few years back, CARO was not applicable. So cases of CARO, wherever statutory due point was there, institute answered it as per essay 250. As per essay 250, which talks about how to checking about compliance of law. Okay. So wherever clause number 7, that is of statutory due, is applicable, and you see that there is a non-compliance, there are no regular payments, there is a outstanding, there is a non-compliance from company side, along with clause number 7, you include SA 250 also. And there you explain in short. Responsibility of management. It is responsibility of the management to ensure there's a complete compliance of law, rules and regulations and payments are made regularly. Responsibility of the auditor is very simple. First, understand different types of laws applicable to the organization and classify them into clauses having direct effect, clauses which may have material effect, and other laws. Simply classify laws and go and check. When it comes to laws which are having direct effect, check compliance of the law which may have material impact, check non-compliance, whether non-compliance has happened, and other laws, no need to check anything till the time there is a suspicion. So explain overall responsibility with respect to different types of laws. We have studied this in SA 250. Overall responsibility with respect to different types of laws. Then explain what happens if they come across non-compliance. Okay. When they come across, you just have to give overview. What is the overall responsibility of management? Then overall responsibility of auditor. What to do if there's a non-compliance? Get a complete. Remain alert throughout the audit. You may come across non-compliance. If you come across non-compliance, obtain all the information. Go and discuss with TCWG management everything. Get each and every important detail. If you're not able to understand things, obtain legal advice and simply understand what is the impact on financial statement, what provision should be made, whether there's an impact on going concern, and check whether company is making provisions and giving all the effects. If answer is yes, you give a clean report. If answer is no, you go for qualified or adverse opinion, as the case may be. So it's very simple. Whenever clause 7 is there, there's a non-compliance involved, explain 250. Management responsibility, auditor responsibility, about overall laws, and what to do when there's a non-compliance. Whenever we talk about provisions, always give reference of AS 29, because whether to recognize provision and what amount it should be recognized is explained under AS 29. Now next, I've marked this also as important. That is transaction, Tata Steel. If during the year this has happened that company is disclosing undisclosed income, black money to the government, to IT department. Okay, if this is happening, explain that this has happened and whether it is recorded properly in books of accounts. It's very simple, straightforward, guys. So if any company is voluntarily going to the government departments and disclosing that yes, this is the black money we have, tax it, correct? That's a very good thing. So this should be given in CARO report. So as auditor, we will explain in CARO report, yes, during the year, so much income was declared, so much income was surrendered, disclosed voluntarily by the company. And we have to comment whether this thing is brought in books of accounts and properly recorded. Now guys, as per schedule 3 amendment, company has to explain this in their notes to accounts also. So see, reporting is happening at two places. Company has to report this in their notes to accounts also, and auditor has to report it in CARO report also. So reporting is happening at two places. Okay. And for the analysis, only things which are voluntarily reported will come here. It may be before or after the raid. If additions are made by income tax department on their own, they won't be reported here. And such kind of declaration will be treated as extraordinary in P&L as per AS 5 and Ind AS 8. These will be considered as extraordinary income. Declaration of black money, bringing black money in books is definitely an extraordinary activity. Now, next is loan, borrowings. I have marked is important. Guys, the earlier clause was loan given. The earlier clause was regarding loan given. And this clause is, guys, regarding loan taken. To understand the difference. So when we talk about LinkedIn, clause number 3, that was loan given. And we talk about LIC, this is repayment of loan taken. So what are we supposed to comment? First thing, we are supposed to comment on default. Very simple, straightforward. Whether during the year there is default in repayment of the loan. about whether it is principal or interest, whether there is default in repayment of loan or payment of interest. If there is a default to any lender, details need to be given. What kind of loan it was, who was the lender, amount not paid, whether it was principal or interest, and delay in number of days. So if company is defaulting repayment of loan or payment of interest, all the details need to be given irrespective of who is the lender. That is important. Who is the lender doesn't matter. Okay, name should be given only if the lender is government, banks, or financial institutions. So listen, it is covering all the types of loans, not just loan from specific people, all the types of loan. This is the change as compared to earlier CARO. And whether any authority has declared company as a willful defaulter. See, authorities are having power as per RBI to declare a company as a willful defaulter. Whether company is declared as a willful defaulter during the year, even this needs to be reported. So we are supposed to report about defaults and whether company is declared as a willful defaulter. Then we also have to comment on usage. So when it comes to usage, we can divide it in two parts. Usage in general means all the usage about all the loans company has taken. First, term loans. Term loans means where the tenure is 36 months or more. 36 months or more. Whether company has you applied loan for the proper purpose for which it was taken. If not, we have to specify this is the amount which was not used for proper purpose, and this is the purpose for which it was used. For example, they took loan to build a factory, but 500 crore loan to build a factory, but out of that 100 crore was used 100 crore was used to get license of some other business. We'll have to report it that during the year so much term loan was taken, 500 crores. Out of that, 400 crores was applied for proper purpose, and 100 crore was diverted. And instead of using it for plant, they were using it for some license. Then, same for short term loan. So, we have to comment about the usage in general, whether the term loan money is used for proper purpose. Then we have to comment whether short term money is used for long term purpose. If answer is yes, amount and nature for which it was used. We have to make comments in general about term loans, about short term loans. See, it is suicidal. You are taking a loan, of 5 years, 1,000 crore loan for 5 years, and you are using it for aeroplanes, aircraft. Their useful life is 20 years. Aircrafts are going to earn money over a period of 20 years. Okay? And you have used a loan of 5 years. How the hell you will generate the money to repay it in 5 years? It is suicidal. However good business you do, if asset is going to generate money over a period of 20 years, then the financing term should be also 20 years. If it is 5 years, how the hell will you make payments? That's a mismatch. This is the principal reason why many entities collapse, because they are not matching the recovery period of the business and repayment period of the loan. So in case of usage in general, we have to comment about term loans and short term and short term loans. Then okay, now the usage of loans taken, which is connected to group of the company. Group means I'm using this term for subsidiaries, joint ventures, and associates. So auditor has to comment two things: whether company has taken any loan, any funds for obligations of subsidiaries, joint venture, associates. Give details. That means whether company has taken loan, taken funds, okay, so that it can give to subsidiaries, give to joint ventures or associates, give details. Further, whether company has taken any loans by pledging, giving as a security, shares, securities of subsidiaries, joint venture, associates. See, these two are two different things. And even the fact that whether there is any default, see, they're two different things. Number one, once again, whether it has taken loan so that it can finance requirements of subsidiaries, joint venture, associate. This is one thing. And the second is whether shares, debentures, bonds of the subsidiary, joint venture, associate were given as a security and loan was taken. Okay, two different things. So in first, you are using money for these group people, and second, you are using shares, debentures of the group people to raise finance. You can say this one is for group, okay, and this one is financing taken using group. Now let's freeze. So here we have to give details of defaults. That's very simple, straightforward. If there's a default of any loan, principal or interest, we have to give details, and whether anyone has declared company as a willful defaulter. When it comes to usage, in general, we have to comment. In general, we have to comment about the term loans. We have to comment about utilization in case of term loans, short-term loans, and then utilization in case of loans which are connected to group. Connected to group. Now, one more thing, guys. One more thing, that when I say that usage, we don't have to see every rupee usage. No. We don't have to see, okay, 100 crore came to this account. This is the check which is given, whether each and every check is for proper purpose. No. We have to see in general, in totality. That means, suppose loan taken is 500 crore and it is for a plant, and you can see a plant constructed for 750 crores. It is understood that 500 crores of loan are utilized. That is sufficient. No need to do anything else. So we don't have to see one to one. In general means overall utilization is there or not. Let's go in detail one by one. What if there is a dispute? Okay. What if there is a dispute? Listen, guys, if there is a default because of dispute, you first explain that there is a default. You give details, and then you explain that this default is due to dispute. If there is a dispute, that doesn't mean you don't have to report it. You have to report the default and then also explain it is because of dispute or dispute is going on. What if loan gets rescheduled? See, rescheduled, that means bank, financial institution is giving us more time, whatever, restructuring, reschedulement. You have to explain this was the old terms, there was a default from our side, and then reschedulement happened. So basically in both the cases they're saying give details of default and then explain there is a dispute, and then explains that now this loan is rescheduled and payments are happening as per the rescheduled terms. Now, declaration after balance sheet date. What is this? Suppose if company is declared willful defaulter not during the year but after the year end, whether we will take it in CARO report? That's very interesting. The answer is yes. If company is declared willful defaulter till the date of audit report, even that will be considered. This is as per the principles of 560 as explained in guidance note of CARO. Definitely it will be considered. See, they have not expressed any date. So we have to consider facts till the time audit report is signed. We have to consider all the facts. If at the time of signing audit report declaration is made, we will write, we are making CARO report. We will consider all the information till the time report is signed. Show cause notice. If there is only a show cause notice for willful defaulter, even this detail should be expressed that company is not yet declared willful defaulter, but there is a show cause notice. Give this information. We don't have to see one-to-one usage. We have to see overall, in general, usage is proper. Sometimes money is invested in temporary investment. It's absolutely fine. This is not called default. This is not called misutilization. If money is kept for temporary period in mutual fund, is absolutely fine. Just mention that this much money is kept in mutual fund for temporary period till the time it is required for utilization. This is not misutilization. If there is a diversion of fund, you need to explain amount, uh, which nature, which type of loan was taken, how much amount was diverted, for what purpose it was used, first purpose for which it was sanctioned, then the purpose for which it is used, and remarks. That's fine. That's not very important. Next, we have marked this important. Fund raised. If now here, listen guys, in the earlier clause, okay, we were commenting about the defaults and utilization of loans. Here we have to comment about utilization of money raised from IPOs, FPOs. If during the year company has raised money from IPOs, initial public offer, further public offer, by issue of shares or issue of debentures, we have to comment, is it used for proper purpose? Is it used for proper purpose? If not, then we have to give details about the delays, defaults, and whether the rectifications were done. And now keep this in mind, even debentures, IPF, even money raised from debentures, it can be targeted in MCQs and exams. Whether money raised from debentures will be covered in this clause. Answer is yes. Further, if money is raised through preferential allotment or private placement, okay, what is different between preferential allotment and private placement? When shares are issued, when offer is given to few people and only they can exercise it, that is private placement. But when a listed company is making a private placement, it is called preferential allotment. When an unlisted company makes it, it's a private placement. When a listed company makes it, it's a preferential allotment. That's the only difference. When an unlisted company does it, section 42 is applicable. When a listed company does it, section 62 plus SEBI regulations are applicable. So if private placement or preferential allotment is done and money is raised for shares and convertible debentures, only convertible debentures, not all debentures, we have to check whether in case of private placement there's a compliance of section 42, in case of preferential allotment is compliance of section 62, and is money used for proper purpose. So what is the difference? If you're raising money through IPO, FPO, okay, we just have to comment about the purpose. But if you are raising money through private placement, preferential order, you have to comment on compliance also and purpose also. If not, we have to give details. Okay. Now let's see, guys. ADR, GDRs are not IPOs, FPOs, because in ADR, GDRs are not IPOs, FPOs. They are private placements. Okay, just keep that in mind. What is ADR, GDR? If Indian companies goes to American capital market and raises money, or globally any other country and raises money, that is ADR, GDR. What happens? Indian company makes private placement to foreign banks and financial institutions. Okay, then these guys, they issue securities denominated in dollar or pound or euro, and then issue it in their capital markets. For a company, ADR, GDR is not issued directly to the public. First is a private or preferential allotment to banks and foreign banks and financial institutions. And for banks and financial institutions, it is an offer for sale. So just keep in mind, I don't think it will be targeted in exam, that we don't consider in IPOs. They are considered as a private placement or preferential allotment, as the case may be. Again, no need to see one-to-one utilization of money. Overall, whether money is used or not. If you're using money for improvised version of asset, that is a proper utilization, no problem at all. So money was raised to make plant A, and now you are making plant B, which is a better version. It is absolutely fine. If money is kept in short-term investment, it is absolutely fine. No problem at all. No problem at all. Just disclose it in the report. Reporting, if they are only for defaults and non-compliance. If they are defaults or non-compliance, you have to give details. Again, not very important. Guys, not very important. I don't think, and that's very simple only. That this was the nature of amount which we have raised. This was the proper purpose. It was diverted for this purpose. Those details are given. What is difference between private placement and preferential allotment? We have already discussed that. Now next is fraud reporting. You have to report very simple thing. Again, this is important. Fraud reporting. So as an auditor, we have to report all the frauds by the company. If company is doing fraud on others, everyone, it's suppliers or employees or customers, by the company or on the company, by everyone, noticed or reported. Noticed or reported to the management. That means we are going to report all the frauds by the company or on the company which are noticed. That means company itself has identified it or anyone else has reported it to them. Like internal auditor has reported or cost auditor has reported or government officer has reported, anyone has reported. All the frauds will be covered here. We have to give nature and amount. That's very interesting. Okay. People will think that CARO report is prepared by statutory auditor and they're talking about the fraud. That means we have identified all the fraud. That's not the truth. In this point, we have to give details of all the frauds on the company, by the company or on the company, which are noticed or reported, which are noticed by management or reported to management by any auditor. It can be anyone. Okay. Then we also need to find out, comment whether during the year any reporting was done under 143.12 in the form ADT4. That means whether any high value fraud was reported to government. Reported to central government. That is for above 1 crore. 1 crore or above. That means if you have done reporting of small frauds only to audit committee or board of directors, that information did not be given here. And whether during the year whistleblower complaints were received. Whistleblower complaint means people. So whistleblower mechanism, that means when officers, employees of the company are going against the management of the company and saying that there's something wrong in the company, the financial irregularities, financial statements are wrong. Such instances are called whistleblower complaints. Whether such complaints were received during the year and whether auditor has read them carefully and considered them, whether it leads to any real fraud. For example, there was a open letter, and this keeps happening in listed companies. Open letter pointing out a lot of problems in Sun Pharma. Then there was an open letter pointing out a lot of problems in Infosys. But then, when these both letters were scrutinized and a committee was formed to go in detail in the matters, there was no financial irregularity. So it simply says, have you read the things properly and considered them? Yes or no, simply answer it. Whether it leads to fraud or not, it is a different thing. Whether you have paid attention to that. So first, comment about all the frauds. Next, whether fraud reporting was done under 143.12 to government. And next, whether whistleblower complaints were considered by you. What is the difference between 143.12 and here? In 143.12, only frauds by officers and employees on the company are covered. So scope of this clause is much bigger as compared to fraud reporting in 143.12. The coverage is much bigger. When it comes to details, all the frauds reported or noticed by the management. All noticed by them or reported to them by any of the auditors or any person. All frauds are covered here, irrespective of whether detected by the auditor. Only when ADT 4 is filed, so it will come only in for big frauds. Only if there are complaints, whistleblower mechanism complaints. Now, next is not very important regarding needy company. So needy companies are mutual benefit companies. In this, what happens? These needy companies, they float schemes. Suppose they float scheme for uh, 100 members. That 100 members will give 1,000 rupees every month in the scheme. So total 1 lakh rupee will be collected, and then there will be a lucky draw, and this 1 lakh rupee will go to them, or they can uh, they can go for auction. Person who is ready to pay more interest will be given the loan, will be given amount of rupees, more interest, or you can say more sacrifice. The sacrifice means uh, they will ask who is ready to sacrifice 2,000 rupees out of 1 lakh, then 3,000, 4,000, 5,000. The person who is ready to sacrifice more amount will be given that money because he is in need of that. There can be different types of scheme, but this is very good. Any one of the 100 people will get 1 lakh rupee, and with that down payment they can buy a car and start Ola and Uber. So there are many marginalized people which are not entertained by banks, which are never entertained by financial institutions. They don't have documents, records, nothing, but they want to work hard, they don't have money. So they can join such kind of schemes which are run by the needy company and get the money and start their businesses. The same format, if it is done as per Companies Act, it is called needy company. When it is done as per local laws, it is called as chit fund. To keep needy companies financially sound, there are rules, and rules say important things. If company is not complying with these important things, we need to report here. What they say: if needy companies ratio of net own funds to deposit is exceeding 1 is to 20, they are going against the needy company rules, and we have to report, yes, ratio has exceeded 1 is to 20. Funds which are brought by the shareholders and funds which are raised through deposits, the ratio is exceeding 1 is to 20. It's extremely dangerous. We will have to report it here that ratio is exceeding 1 is to 20. Now, then next, whatever deposit they receive, just like banks, whatever deposit they receive, 5% is kept with RBI and 25% is kept with them, CRR, SLR. On same lines, whatever deposit is received by needy company, 10% of that, 10% of deposit received, 10% of deposit received has to be maintained in the form of FD, which is unencumbered. That means without any charge, not offered as security anywhere. If they are not maintaining it, again we have to report it. So if ratio is exceeding 1 is to 20, report it. If they are not maintaining 10% of deposit received in the form of unencumbered fixed deposits, that is for liquidity, report it. Further, if they are defaulting repayment of amount or interest on deposits, again report it. So if needy company is going against the rules, breaking the ratio, not maintaining FDs, or doing defaults in repayments, it will be reported. So if needy companies are going not doing proper things, they are going against rules, regulations, these three things will be reported and they will be exposed. Now, I don't think it can be targeted, but still, whatever FD you have to maintain in the month of August, it will be on the basis of what is the level of deposit received on last day of second preceding month. That means for the month of August, they will have to maintain 10% in the form of FD. Now 10% of what? 10% of deposits. Deposit level as on, go to first preceding month, that is July. Second preceding month, that is June. Go to last day, 30th June. That will be on the basis of what is the level of own deposits as on 30th June. Suppose that is 10 crores. So they have to maintain FD of 1 crore in the month of August. Why this is there? So there's a time lag. Let's freeze. Whatever FD we have to maintain in August, correct? That will be on the basis of deposit level as on 30th June. Why so? So that in between you get gap of 1 month, 1 month to make proper arrangements. Okay, less chances it will be targeted, but you should be aware that needy companies get 1 month time lag to keep proper maintenance. That's what is written. Ratio is net own funds, maintaining net own funds. Deposit is 10% unencumbered. Same thing is report. If there's a default, give details. What is defaulted, amount, period of default, people, and any other detail. Next is Reliance, related parties. Very simple. If company is entering into related party transactions, whether these transactions are properly authorized. Under section 177, audit committee approval is required. 188, board of director approval is required. For some, ordinary resolution is required, and for some, special resolution is sorry, there's no special resolution. Sorry, only ordinary resolution. Earlier, much before when the Companies Act came, special resolution was required. Now it is not required. So whether proper approvals are taken under 177 by audit committee, proper approval is given by audit committee, then as per 188 by board of directors, in some cases by shareholders by ordinary resolution, proper approvals are taken. And second, are they properly disclosed in notes to accounts by respective AS and Indies? Simple. What do you mean by related party? That will be as per section 2, clause 76, related party definition. 177 talks about audit committee approval, 188 talks about BOD approval, and sometimes by shareholders in the form of ordinary resolution. Disclosure, it is given under AS 18. Then next clause number 14, that is Indian Oil, about internal audit. Whether the internal audit department, internal audit function in the company is commensurate, suitable as per the size and nature of the work conducted by the company, and whether statutory auditor has considered the report made by internal auditor. We as a statutory auditor has to see whether company is having proper internal audit, whether internal audit is whether the internal audit arrangement is proper. This arrangement there can be internal audit department, or they can hire a CA firm. So whether proper arrangement is done, there is enough big team, are they given proper scope for doing the internal audit, and whether we have read their report. So two things we have to comment. We have marked this important because it's a new thing. It is applicable to all the companies where CARO is applicable. Next is nuts, non-cash transaction. Non-cash transactions means barter. Okay. So one asset is taken and one asset is given. That is called as barter. Let's understand. Let's understand. Now, section 192 is applicable. It says that if directors of holding company or company or subsidiary or associates, if directors of company, its holding, its subsidiary or associates are doing non-cash transaction, barter with the company, that's a very, very risky transaction. Such a influential people are doing this, there can be a big mismatch in the asset exchanged. So for doing this, ordinary resolution will be required by shareholders in the company. Further, if such person is a director of the holding company, then ordinary resolution will be required in the company in which transaction is happening, and also in holding company. Then only this transaction can happen. So, and this is a section 192. If there is a non-cash transaction by directors and connected people, director of connected people of so and so companies, then section 192 is applicable and ordinary resolution will be required in that company. And if director is director of a holding company, then there also ordinary resolution. If director in holding company, and listen, if director, so here it should be if director of holding, then ordinary registration will be required in holding company also. Okay. So non-cash transaction, if the payment is in cash or cash equivalent, then it is not a non-cash transaction. It will not be covered here. If mergers are happening approved by court, that is not considered as a non-cash transaction. So if directors of such people are doing non-cash transaction with the company, the same thing. Prior approval will be required. Then only transaction can take place. Now this is important. Okay, guys. Now next is NBFCs. Listen, guys. NBFCs are not exempt. That means CARO is applicable. So if you're doing audit, if auditor is doing audit of a NBFC, then this clause will be applicable. So this clause is specifically if you're doing audit of NBFC. So first point is related to registration. So we have to comment whether this NBFC is required to get registration. Guys, 99.99% NBFCs need to get registration. Only few are exempted. So first understand, are they required to get registration? If answer is yes, whether they are having valid certificate of registration. So we have to first comment, are they required to get registered? If answer is yes, we have to comment whether valid certificate of registration is taken. Second, we have to comment, have they performed any activities related to NBFC, which is generally performed by NBFC or housing financial entities without valid COR certificate of registration. So first we need to tell whether valid certificate of registration is taken, and second we have to tell, have they done anything without certificate of registration, because these things will be considered illegal and questionable, and they may be legalized or regularized as per instructions of RBI. So these two are very, very critical, because if there is problem in these two things, it can challenge going concern straight away. So we have to comment on the registration. Next, whether this NBFC is core investment company. When an NBFC is incorporated only to finance a particular group like Reliance Group, Adani Group, Birla Group, or particular group of companies like Tata's, it is called core investment company. Their objective is pretty simple: raise finance in bulk from across the world at cheaper rate and give it to their group companies. Okay. So first we have to comment whether they fulfill the criteria to become a core investment company. Listen, guys. So they have criteria. We don't have that in our course. Like 90% of the money should be invested in particular group only. Out of that, 60% should be invested in equity only. And there are monetary limits which should be achieved and so on. So that will be core investment company. Then core investment company will remain unregistered till the time their net assets is not exceeding 100 crores. So we have to comment whether they are fulfilling the condition to remain unregistered. So first, are they fulfilling definition of core investment company? Are they fulfilling the requirements to remain unregistered? And third, whether there are more than one core investment company for that group. Yes, there can be multiple core investment company. One company raises money from US and Europe. One company raises money from other countries of the world. Okay. One raises money rightly from capital markets of India. There can be multiple core investment companies. So we have to comment three things: they fulfill definition, they fulfill criteria to remain unregistered. Yeah, that's the great thing. Core investment companies don't need to get registered, because they directly don't deal with public. They don't raise money through deposits. They raise money through big groups and financial institutions and big funds, because public in general is not involved. So RBI says, okay, don't get registered. So are they fulfilling the definition of CIC? Are they fulfilling the requirement to remain unregistered? And then where there are more than one CICs, I think it's extremely important, can be targeted in exams. Okay, we know the meaning. They are there for particular business group till the time if their asset is 100 crores or more individually or in aggregate, then they will need registration. They become systematically important. Systematically important, that means the term used is systematically important CIC. They don't need registration in general, but as they become systematically important, they need to get registered. Exempted CICs need exempted CICs or unregistered CICs, that same. If you are exempted, you can operate as unregistered CIC, no problem. Next is about cash losses. Cash losses means you take losses and add back non-cash expenditure like depreciation and amortization. If after adding back non-cash expenses, after adding back non-cash expenses, okay, still if there is a loss, that is called as cash loss. So we have to comment whether there are cash losses in the current year and in the previous year. If yes, we have to mention amount of such cash losses. So if in 1 year there is a loss and 1 year there is a profit, we have to clearly explain that only in the current year or only in the preceding year there is a cash loss, and this is the amount of cash loss. Okay, so we have to, many auditors prefer to comment individually, first about the current year, then about the preceding year, whether there are cash losses. Very simple, straightforward. Next, resignation is about resignation, important. It happened in 2018. Many auditors resigned. In 2017, rotation got applicable. Many new auditors came to the companies and they resigned in 2000. There was a mass resignation in 2018. And these guys, they didn't give proper reasons. And authorities, SEBI, everyone was annoyed. From that time itself, they are screwing auditors over resignation. So if during the year, if auditor has resigned, if any statutory auditor has resigned, whether the current auditor, present auditor, whether the current auditor has clearly read the reasons given by the resigning auditor, his issues, objections, everything by previous auditor, outgoing auditor. So auditor has to comment that whether you have carefully analyzed, read issues, objection raised by the previous auditor who resigned. So it is obligate. We have to comment whether we have read it. So it becomes an obligation on the auditor that you read carefully all the reasons given by the resigning auditor, outgoing auditor. Then next is material uncertainty. What do you mean by material uncertainty? So discovered by say 570. When happening or when going concern is dependent on happening or non-happening of future events, it means there is a material uncertainty over going concern. Okay, so on the basis of financial ratios, aging and expected dates of realization and payments of expected, when we are going to get money from the asset, when we are supposed to pay, and on the basis of other financial information, auditor has to comment, analyze carefully financial ratios, expected receipt payments of next 12 months and other information. We have to comment whether there is a material uncertainty over the company as on audit, as on date of audit report. Next, we have to also comment whether company is capable of meeting its liability. So we have to comment whether company will be able to pay liabilities arising over the next 1 year. Going concern is about next 1 year. We have to comment whether they will be able to pay their liabilities which are falling due within next 1 year. Concept of material uncertainty is as per SA 570, and ability to pay liabilities within 1 year. These are two things we are supposed to comment. Now, guys, you study this in law section 135. I'm simply explaining. See, section 135 says that every year you are supposed to spend 2% of the average profits on CSR. Suppose this average, suppose 2% comes out to 200 lakhs. Okay, 200 lakhs. So you have to spend it on CSR activities. Suppose out of that you have company has spent 120 lakhs on CSR activities. Schedule 7 of the Schedule 7 to Companies Act explain these are the reasons, these are the purposes for which you can do CSR expenditure. Now, unspent amount is 80 lakhs. Now, this is the whole thing. So, what will happen with respect to unspent amount? In section 135, there are subsection which says that, fine, if the amount has remained unspent, if you say that, if you prove that and explain that if you explain that it is for ongoing project. Ongoing project means multi-year project. Then suppose 60 lakhs is for ongoing project. That means this project is not going to get over in 1 year. This project is over a period of time. It is going to take time. So transfer that money within 30 days from the end of the financial year to unspent corporate social responsibility expense, unspent amount, and spend it over next 3 years. If you don't spend it within 3 years, this amount, if not, transfer this amount within 30 days in the fund. So there are funds in Schedule 7. Transfer it to any of the funds as given in Schedule 7. Now, that's very interesting. And if amount is unspent and this is not for ongoing project, that means there is no valid reason, then within 6 months it should be transferred to fund which is specified in Schedule 7. Okay, so it is about unspent amount. Either you say that it is for ongoing project and you get liberty to spend it over a period of 3 years. If not, within 6 months transfer it to the fund. That's what. So this is governed by section 139 135 subsection 5 and 6. Subsection 5 is other than ongoing project, and subsection okay. So 139 135 5 135 5 sorry 135 5 is here, and 135 6. So as an auditor, we are supposed to comment whether 135 5 and 135 6 are complied with, in short and in simple manner, and that this much is only relevant for the audit. You don't have to think much and go in law. You can go in further detail. A very interesting clause number 21. This is the only clause which will appear in audit report of consolidated financial statement. Yes, this will not appear in audit report of standalone financial statement. It will appear on audit report of consolidated financial statement. So if there are qualifications, adverse remarks in the audit report of the entities like subsidiaries, associates, joint ventures, which are consolidated in the parent company, then details of such qualification, you simply have to give details in which clauses there is adverse reporting. We have to indicate in which clause number of CARO there is an adverse reporting. Let me show you. See, this is Reliance Infrastructure. So this is audit report on consolidated financial statements of Reliance Infrastructure. If in the whole group which is consolidated, if in any clause qualification or adverse remark is given, those details should be indicated here. So in Reliance Infra Group, there are 22 companies they are saying. So number is given, list is given, that these are the companies, this is identification number, what is the status of that company in the group, and these are the clauses where qualification or adverse reporting is given. So in Reliance, clause number 1, 3, 7, there is a qualification adverse reporting. Then Delhi Airport Metro Express, there's only in one clause there is a adverse reporting. So we have to indicate in each company in which clause there is a qualified or adverse reporting. So investor can know offhand if he wants to read adverse points. It's an index. He can simply go to those points and read only those. Guys, we are through with the CARO. Through with the CARO. There's and even this should be clause number 21 should be marked as important. Okay, I think this much discussion is sufficient. Go to give more importance to the important clauses and definitely corresponding questions. That will be sufficient.